Welcome to this explainer. Today, we're going to take that static, intimidating wall of numbers known as the income statement and turn it into a dynamic story. Because whether you're investing your hard-earned money or running a small business, understanding how an income statement functions on a daily basis is absolutely crucial. We hear buzzwords like top line and bottom line thrown around all the time, right? Well, today we're figuring out exactly what happens in between.
Here is our roadmap for the journey. We'll start with the big profit and loss picture, trace the path from top to bottom line, separate operating from non-operating costs, expose some major accounting blind spots, and finally end with a showdown between international and U.S. accounting rules.
All right, let's jump right into Section 1, the profit and loss picture, and break down what this financial document is actually doing.
Fundamentally, the income statement, or P&L, is your scorecard. It shows exactly how revenues at the top line transform into net profit over a specific time frame. Whether a business is selling fitness gear or corporate consulting, every single daily sale and every daily expense feeds right into this statement. It exists to answer one simple but incredibly vital question. Did the company actually make money, or did it lose money? Think of it like this. A balance sheet, that's just a static snapshot. It's exactly what a company owns at midnight on New Year's Eve. But the income statement, that's a video recording. It captures the daily hum of business, the constant flow of money coming in and going out over an entire quarter or year.
Moving on to Section 2, from top to bottom line. Let's see how that financial funnel actually works in practice.
To really understand a company's daily operations, we use a multi-step method. Picture a giant funnel. We start wide at the top with all the revenues. First, we peel away the direct costs to get gross profit. Subtract the everyday overheads, and we get income from operations. Then, we adjust for other random revenues and expenses to find income before taxes. Finally, the tax bill hits, and boom, we land at the very bottom line, net income.
Let's look at a real-world example to see this funnel in action. Check out Green Harbor LLC's 2010 statement. Their daily grind brought in over 296,000 euros in gross revenues. But, running a business isn't free. As we move down the statement, you can see those top-line revenues getting steadily chipped away by various business expenses, totaling over 195,000 euros.
So, after paying for literally everything, from subcontractors down to printer paper, Green Harbor walked away with exactly 100,882 euros in net income. That is the bottom line. It's the ultimate measure of their entire year's worth of daily effort.
All right, Section 3, operating versus non-operating. To really understand how we get to that bottom line, we have to separate the boring daily costs from the weird one-off expenses.
Breaking down Green Harbor's specific expenses, it's pretty clear that direct operational costs eat up the vast majority of the revenue pie. Subcontractors took 88 grand, and materials took over 74 grand. Compare that to everyday rent at 13,000 or advertising at just 6,300. Grouping these correctly is exactly how we measure if a company functions efficiently on a day-to-day basis.
To make sense of all this, accountants split expenses into buckets. First up is cost of goods sold, or COGS. These are the direct costs of making or acquiring what you sell. If you're building a chair, the wood and the carpenter's wages go right here. We intentionally leave out general office overhead so we can isolate pure production efficiency.
Those remaining everyday costs, they fall under SG&A, selling, general, and administrative expenses. This is the stuff you need just to keep the lights on and manage the business. We're talking executive salaries, office utilities, store depreciation, and insurance. These are the inescapable daily operational costs of keeping the doors open.
And then, completely separate from the core business, we have the non-operating section. This is a catch-all for unpredictable or financing items. Things like foreign exchange losses, a random one-time gain from selling an old truck, or interest paid to the bank. Keeping these separate is crucial. A massive fluke foreign exchange loss shouldn't trick us into thinking the company's actual daily business operations are failing.
This brings us to a huge pivot in our explainer. Section 4, limitations and blind spots. It is time to shatter the illusion of absolute financial certainty.
You look at a flawlessly balanced, multi-step income statement, neatly organized down to the exact dollar, and you kind of have to wonder, are these numbers absolute facts? Is that final net income an indisputable, objective truth about the company's health?
Well, no. The reality is that these statements have some massive blind spots. For one, they totally ignore unmeasurable assets. You will never find customer loyalty or brand recognition on an income statement. Second, they rely heavily on subjective choices. Depending on whether management uses the LIFO or FIFO method to count their inventory, the reported profit can look drastically different. Plus, there's a whole lot of guessing involved, like estimating exactly how many years a machine will last just to calculate its depreciation.
And that reliance on subjective rules leads us perfectly into Section 5, IFRS versus US GAAP, the fascinating battle of the accounting rulebooks and how they literally dictate the daily reality we see.
To see how regulatory rules shape the narrative, look at the timeline for Dexterity Inc., a company operating under US GAAP. Their reported profits swung violently. In 2019, they posted a massive $8.4 million loss, but the very next year, suddenly they're showing a $4.4 million profit. How? Because back in 2019, they were forced to take a nearly $18 million impairment write-down.
This creates a crazy contrast between international rules, IFRS, and US GAAP. Two identical companies can have the exact same daily operations but report completely different profits simply based on where they're headquartered. International rules ban certain tax shielding methods like LIFO, but they generously let you reverse past impairment losses if an asset's value recovers. US GAAP, on the other hand, allows LIFO, but they are strict on impairments. Once you write it down, that loss is permanently baked in. No takebacks.
Because bottom line profit can be so easily skewed by these weird rules and one-off items, investors often look deeper. They rely heavily on diluted earnings per share. This metric assumes that every single stock option, warrant, and convertible bond is transformed into a share. It shows you the absolute worst-case scenario for dilution, making it a much more grounded, reliable way to understand your true stake in the company.
So, as we wrap up this explainer, I want to leave you with a question to chew on. If two identical companies can report wildly different net incomes simply by choosing a different inventory method or operating under a different rulebook, what is the ultimate truth? When you look at an income statement tomorrow, are you seeing the objective reality of how that business functions daily, or are you just reading a cleverly structured story that their accounting methods are allowed to tell?